cash flows using the indirect method. Starring James Anderson. Narration by William Martin Jr. Featuring Gerardo Cortez. Today we are going to demonstrate the cash flow of operating activities using the indirect method. Hopefully this video will help you further understand why an activity is either added or subtracted, when increased or decreased. First of all, what is a cash flow statement? A cash flow statement is a method of tracking the cash flowing into and out of a business. The cash flow statement will contain three different sections. First, we have operating activities. This section adjusts for day-to-day operations, such as sales, expenses, and payments. Next, we have investing activities. Investing activities involve the buying and selling of long-term assets, such as land and equipment, as well as short-term investments, loans, and bonds. Finally, we have financing activities. Financing activities involve borrowing money from creditors, paying dividends to stockholders, as well as collecting money from the sale of stocks. However, today we will be focusing on operating activities, which can be the most confusing of the three. Let's pretend William has a guitar shop. How you doing, Will? What a guy. In order to successfully fill out his statement of cash flows, William needs to know whether to add or subtract each activity from the net income. There you go. Adjusting for non-cash expenses and losses. First, we will adjust for non-cash expenses and losses, meaning cash does not flow. For example, depreciation is an expense that has been deferred to this period without any cash moving. The business cash balance is not changed by the depreciation of its assets. Other examples of non-cash expenses are amortization and depletion. Because we deducted the expense without paying anything, we need to add this expense back in. Second, he will need to analyze net changes in current assets and current liabilities. Current assets, as you should all know, are things like cash, inventory, accounts receivable, and prepaid expenses. Let's start with inventory. Let's say our inventory decreases, which unless it was stolen, is a good thing because that means we sold something. Therefore, we had cash flowing into the business, meaning we can add the decrease in inventory. Next, let's look at accounts receivable. Let's say it increases. This means we sold something. However, we did not receive the payment for it, so this increase will be reduced from the net income. Look at that winning smile. With prepaid expenses, the key word is paid. If the amount you prepaid increases, then cash was being paid, or cash was flowing out. So we subtract this increase from net income. Let's take a look at current liabilities. If accounts payable increases, this means that we gain an asset without even paying anything today. We need to add this increase to our net income. In this way, salaries payables is quite similar. Even though employees worked, we didn't pay them today. Ooh, doesn't look too good for you. Hopefully the day looks better. Income tax payable is also similar. It would decrease because we paid some of the taxes we owed. Therefore, we subtract this decrease from our net income. The key is to watch the cash. Hopefully this video helps you understand the cash flows of operating activities using the indirect method. Thank you for watching.
Black Beatles in the city, be back immediately to confiscate the monies. Sent flowers, but you said you didn't receive. Mike